Hey, Wes, very good to see you. I want to talk about the recent market sell-off and volatility because it's kind of hard to look at. But listen to these stats. The S&P fell 8.8% for the month of April. The Dow declined nearly 5%. That was the worst monthly loss since March of 2020. The Nasdaq retreated more than 13%, the biggest decline since October of 2008. And as if that's not hard enough to hear, take a look at this. This is a chart from FinViz, which shows the activity for the past month. When I see this much red, Wes, what am I supposed to do?
Wow. I mean, that's a lot of red, right? And
Right.
it shows us that what the Fed giveth, the Fed taketh away.
Yeah.
Things happen quickly. And this is an emotional trigger for a lot of people, as long as
Right.
you're a normal person, because even for me personally, looking at your own money being invested, you see it, lost so quickly. It's like,
Right.
whoa, it's kind of jolting. But this is a time to ask yourself, has your goals changed? Has your long-term plan changed? And at the end of the day, no matter what's going on in the markets, whether it's good or bad for your portfolio, always adjust things by just simply going back to your plan. Maybe it's as simple as rebalancing, because there's opportunities that are created here as well. But the last thing that we want to do is make an emotional, irrational decision, which again, it happens, but consult someone that is there to help you.
Yeah, I'm glad you brought that up because I know you are a student of behavioral finance and we've studied 30 years of data. And what we've learned is that when investors panic and sell, they're almost always doing it at exactly the wrong time.
That's right. And it's, again, so easy to do this. And many studies have shown that folks will, actually lag the market or lag their particular benchmarks. And it's not really due to necessarily fees that they are paying. Well, that's important to pay attention to. It's really the initial reaction to a down market, to losing money, and then trying to get back in at the right time. That's a very difficult thing. So again, it goes back to having a strong financial plan that really, Aaron, should be able to weather all kinds of storms to allow you to stay invested when things are good, but also stay invested when things aren't so good.
Right, because Wes, often those good days are smushed right up against the bad days. And this is from Brookstone CIO Mark Diorio, who has, again, studied the data. This is a 15-year investment. And this is somebody who pulls their money out and misses just the 10 best days and so on and so forth. And look at how that changes.
It could be super expensive to do
Right.
that. It really can. And timing the market, while it might work out here and there, long term, I mean, these corrections are going to continue to happen. Nobody knows exactly when. So again, you just got to be prepared for the all weather. It just really depends on what's going on. But your portfolio really shouldn't have major structural changes just because stocks are doing what stocks do.
Right. But I do want to ask, because there are some experts who are advising investors to be defensive. So what does it mean to be defensive as an investor?
Well, there's many different definitions of being defensive, I think, when it comes to investing. Some think that's generating more cash in a portfolio. Some think that's buying bonds, although this year that's been tested as a theory. Right. But for those that are especially in the accumulation phase, think of this as a time to floor it. This is an opportunity, because if you're buying stocks now and you have an outlook for a very long term, hey, it's really going to work out fine. But if you're in that distribution phase or entering that phase, this feels a little bit different, right? So we think it's a good time to, when you have so much uncertainty out there, Aaron, it's not a bad time to kind of hedge your downside risk. And that might take away some from the upside that you can earn. But when you're in or near retirement, it's about having a consistent rate of return in your portfolio that aligns with your actual plan, with what your goals are, with what your needs are. And that allows you to stay committed to it.
Right. So much to think about and a lot to consider. Wes, if somebody would like you to take a closer look at their portfolio or maybe see if they are in need of some rebalancing, what's the best way to reach you?
Best way to reach us is just give us a buzz at 919-322-4113. Or even just shoot us a message at info@patriotwealthnc.com.
Very easy. All right, Wes, thank you very much.
Thank you.